Hey everybody, welcome back to the Thursday evening Financial Thing live stream. Thanks for joining us. We have a special guest with us this evening. I'm excited about, we'll get to in a minute, but we are here every Thursday evening at 7:30 p.m. UK time, almost every Thursday evening. Sometimes things happen where, it doesn't always happen, like a couple of weeks ago, but most of the time we are here. We're going to be talking about all things peer-to-peer lending this evening. Majorly focusing on that, maybe get into a little bit of cryptocurrency after our guest Andrew Holgate has disappeared from the stream after we've had a chat with him. But so let's bring on the special guest tonight. We're going to have a chat again about all things peer-to-peer lending and what's going on with the market. There he is, Mr. Andrew Holgate, live and direct from Oasis Recording Studios, and that's obviously not true. How are you, Andrew?
I'm very good, thank you. And yourself?
Yes, I am still alive and breathing. As everybody around me gets struck down with COVID, I have somehow managed to avoid this horrible antivirus or whatever they're calling it. But thank you for taking the time, Andrew. Somebody that I've wanted to bring on for a while. You've been in the peer-to-peer lending space for, I would say, a long time. And just so everybody out there understands, we're not going to be able to mention certain things about, Andrew's past company. He's asked me, there's certain legal things that he's required not to be able to speak about that. But we're going to be able to talk about things in a more generic way without necessarily naming something in particular. But Andrew was one of the co-founders of one of the companies on my top 5 list, so I won't mention it directly, but it is in there, and I think most of you that know peer-to-peer lending, I'm sure you could figure out which one that is. So let's get right into it, Andrew. Now, you were involved in this major peer-to-peer company, this nameless peer-to-peer company. What are you currently up to these days? We're going to do a quick brief intro on what you're doing right now, because you obviously changed.
Okay.
Yeah.
So I'd left there 3 years ago now. It's just over 3 years ago, and I took a little bit of time out after starting a business from scratch, building that up. You get to a point where you're mentally exhausted and just need a bit of time to reconfigure yourself. But then I've been involved in some non-executive director work, helping a number of lenders grow, develop. Sometimes it's very project specific for a short period, some longer term engagements as well. But alongside that, I've helped platforms develop their institutional funding side, because peer-to-peer is a great mechanism for raising funding, but there are risks with it for any peer-to-peer lender. So institutional money provides a little bit more certainty and solidity to their businesses, and I've been helping platforms actually raise institutional capital and steady them for the future, especially through times like COVID.
Mm-hmm. And we'll get into the conversation a little bit later on about you are actually somewhat involved, not obviously as an owner or anything like that, but with helping a couple of these platforms that have demised into the administration side of things. And we're going to talk about Lendy and Funding Secure and the House Crowd. So Manchester, obviously almost Manchester-based, the House Crowd. But tell me, how did you enter the peer-to-peer lending space to begin with? What got you into it?
What got me into it? One of my customers was looking to raise money from, I think it was Funding Circle, and they'd also looked at ThinkAds. And they said, have you come across these guys? And looked at them, never heard of them at the time. I think Funding Circle had done maybe about 10 or 15 million of lending, and ThinkAds were about 2 or 3 million of lending at that point. And so I've never heard of them, but I like the way that they are raising this funding. Bearing in mind this was post-financial crisis, so back in 2012, nearly 10 years ago now, and really liked the way that they were doing it. But I thought the markets that they were going to and the way that they were doing it was fraught with risk. The smaller business loans that are unsecured that Funding Circle are doing I felt that they probably held too much risk for the retail investor, and what was termed a sponsor-led model for ThinkCats, where they had brokers who were effectively finding the deals and then writing the credit reports to put them up onto the platform. Again, that's fraught with risk because your sales guy is actually talking about the credit risk, and there didn't seem to be any secondary checks there. So that developed into a conversation about how that could be done better, how we could raise retail capital and help these businesses. That became a business plan, and suddenly I'd left the banking environment after 10, 15 years, and suddenly I was an entrepreneur and running my own peer-to-peer lender. At the time, we came across a very good CTO who helped us build a platform. We'd already built similar software in the past, so that aided us somewhat to actually get to market a little bit more quickly. But beyond that, the next 3 years really a bit of a blur as you try and grow and develop that business. And it was in that very early period. It was quite a nascent marketplace and a lot of excitement around it, and quite a thrilling time to run your first business and grow it to the successful level that I was able to do.
Yeah, and peer-to-peer, it makes a lot of sense when you think about it, because it solves a couple of different issues, even though obviously with all these startup companies there's going to be issues and financial problems that hit some of them. But when you were getting into the space, did you actually invest in peer-to-peer lending loans yourself, or have you ever put money into other platforms and tried it out as an investor?
I'd stumbled across the very early form of Zopa a few years before, and been able to look at the way that they operated. And I thought at the time that was quite an interesting concept. It was only really when I started to look at the marketplace as an opportunity to start a business that I actually started to put money onto some of these platforms to get an understanding how they work, how they came together, what the opportunities were. And this was back in the days of the reverse auction, so it creates a lot of excitement when you're trying to bid and get the highest rate possible without being dropped out of the pot, and then trying to trade those loan units afterwards. So that was started at a very low level, and then as new platforms came along, I would also invest into them just to see the way that they operated and what was available. It's a little bit of market intelligence and trying to work out what your competition's doing, so you don't do anything better than you.
That's what they all do. That's what all the company CEOs do, is they spy on their competitors. I mean, it makes sense. Absolutely. Now, do you still have money invested on peer-to-peer platforms now, or did you exit the space?
It's been infrequent in the last couple of years, partly through COVID, a few personal things that have been happening in my life as well. So we've been trying to move house for 6-7 months or so, and so we need cash available to put into a property. But I will go back to it. There's some good platforms out there, a number that I really like. People like AbleRate, PropLend, Crowd Property. I think Crowd Property actually a lovely platform. I think the way that they go about it, really good deals, very, very well, no defaults at all, certainly no losses. And they offer a good return, and that's what I'm looking for. The lower rate platforms. I think when Zopa's rates and rate setters rates were going so low that it was hardly worthwhile actually putting your cash there. Mm-hmm. So I'm attracted by the higher yields, but that higher yield has to be balanced about the level of risk that's actually involved as well.
Yeah, and I think this is one of the problems that a lot of especially beginning investors face when it comes to picking out which platforms they're supposed to invest in. They really don't understand the amount of risk versus what they're being paid. I don't think a lot of people really understand what they're getting into when they buy these Absolutely. Loans that are paying 12 or 15% of interest. And I think a lot of people got burned, especially with some of the platforms that have gone under. But you mentioned to me, and I didn't remember this, but I remember reading about it a while ago, but you were involved with both Funding Secure and the House Crowd. So what was your involvement with those two companies that have since gone into administration?
So I started with Funding Secure probably 2 years ago, and a new management team had gone in to take the business over. One of their key investors had decided to buy the business because he was worried about his own investment and the way that the portfolio was being managed and how that was going ahead. So he approached me to come and help him have a look at what was going on, change the business in terms of its credit processes, the way that it evaluated loans, the way that it managed the loans going forwards, and even things like loan management systems. Peer-to-peer lenders are lenders. They are putting money out the door. So having a loan management system, so you know how much has gone out, when it's due, what the conditions are of the loan, etc. All those sorts of things needed to be put in place. But it became apparent very quickly as we started to dig into the portfolio that the problems were even deeper than were suspected when the business was taken on. So unfortunately, after a number of discussions, it was decided by the management team to put the business into administration, and at that point I stepped away from there. And then with the house crowd, that was September 2019 when I first got involved with that business. And again, the remit was to take the business on to the next step. They'd done around about 100 million of lending at that point across various different asset classes. And they needed institutional money to help grow and develop the business, but again, systems and processes needed improving and upgrading to get them to where they needed to be. Mm-hmm. Once we got into there, we started again to discover problems within the portfolio. Loans that should have expired 2-3 years ago were still live, and default process is still on running, and that was highly unusual. Just at the point where we were starting to get control of those, then COVID came along. As COVID came along, the FCA came along and said, how's the business performing? Can you tell us what's going on? Are you fit and ready to survive a COVID crisis? And at that point, the business got put into a VREC because the FCA had concerns about the quality of the portfolio at that time and the ability of the business to manage those loans and come out of the other side. COVID probably went on for, well, we'd sort of guessed 3 to 6 months, and here we are 18 months later, still thinking that there could be another winter lockdown coming with all the reports in the press at the moment. And we'd planned for 3 to 6 months, and unfortunately the business just ran out of cash and wasn't able to progress on further. So it sounds like a disaster story that I've stepped into 2 businesses and they've ended up that way.
You're not doing well so far with 2 for 2.
Yeah, I knew what I was getting into at Funding Secure. I knew there were issues there, and that was always a possibility. House crowd came as a bit more of a shock, but I think the work that I did, along with Carl Davis, who came in as Chief Operations Officer, it was more of a soft landing onto the Hudson, the classic plane crash that happened, and everybody got off relatively unscathed. I think it was more like that rather than a spectacular collapse like Lendi has been. So yeah, I'm proud of the work that we did there to slow the decline and make sure that investors come out in a relatively unscathed state. I can't say there won't be losses, but we've done a good job to minimise those.
Oh, well, that's good. I'm sure people will be happy to hear that coming. More inside information, because I think a lot of the times with these administrations, we just really don't have a good idea of what's going on, and the collateral situation is a complete, seems like, disaster mess. And but I wanted to get your take on, what do you think about the Lendi situation will happen? What's your general thoughts on that? You think, obviously there's been some questionable financial activities going on in the background, and was this really a case of fraud or just mismanagement of money? What do you think?
It's hard to say whether it was fraud. And I've worked in the insolvency arena, so my last 4 years in the banking world were helping RBS manage their bad book. So I've done administrations, I've done receiverships, and then running your own lender, you get involved in those anyway as you try to recover loans. Lendi always felt like the slowest car crash in the world. I think a lot of people inside the industry could see what was coming, but it was a question of when rather than if. So when things did start to unravel, then there's I think RSM and Damien Webb have found a lot more in that book than was actually expected from the outside, from what we could see. And it's difficult for me to say whether it is fraud or not, but if the actions that are being taken by the likes of RSM are true, then there's a lot of questions to be asked about the management team, about what they did, where those monies were going. But you mentioned risk before, and you mentioned return before. These loans are being charged at 18, 24% per annum, and investors were getting double-digit returns from them. And whilst they look like they were secured against property, it seems that some of those security structures haven't been put in place properly, that the whole risk assessment hasn't been done properly. High rates come with high risk, and is it any surprise then that some of these loans did go bad? I think one of the things it did highlight is the risk with peer-to-peer, that as soon as there are fundamental issues in that loan book, the confidence in the investor base goes, and then the lender itself hasn't got enough cash available to continue to fulfill all the loans it's got in the pipelines, or certainly the development loans where cash is needed on a regular basis. If there's no cash coming in, then they can't satisfy those, and it just compounds the issue, and it spirals down very quickly.
Mm-hmm. Yeah. So if you're a new peer-to-peer lending investor, or somebody who's even experienced, everybody's looking for yield right now. I think the bond markets are done. I really don't honestly see, government bonds ever paying a decent interest rate ever again. Savings accounts are almost zero. Everybody's looking to try to get some yield. If you're coming in as a new, or even as an advanced lender, you're looking for places to put your money, but you've been burned in the past by these companies that have gone into administration. I've geniusly put my money into 5 companies that have crashed into administration. So, not a particularly good track record, but then I've invested in probably 20 overall, so 5 out of 20. How do you figure out as an investor where you can put your money in a somewhat safe manner nowadays?
Due diligence. I approach it in the same way that I approach a lending proposition. You've got to dig deep. You've got to look at the fundamentals behind that business. So people like Lendy, Funding Secure, HouseCrowd, they were set up on the back of a very, very low capital base. The barriers to entry 10 years ago were very, very low. Yes, there was a regulatory environment, but peer-to-peer sort of fell between the cracks of a number of different regulatory frameworks. So when the FCA finally tightened that up and created a specific piece of regulation for the industry, then that moved people along. But by then, these platforms had already got traction, but they hadn't brought in place the right people. All the buzz around fintech, a lot of it is on the technology side, but it's actually fintech. It's financial services enabled by technology. And this is where a lot of these platforms have fallen down. They haven't got this financial services part right. So when I set my business up, it was all about how do we behave in a regulated way without actually having a specific piece of regulation? How do we make sure that we are credit assessing these opportunities in the right way? How do we make sure that the investors are protected? And investors should be asking those questions. They should be talking to the customer services teams, finding out what the credit policy is, what the legal structures are to make sure that the security is taken, what are their rights when the loan goes bad. Actually, the platform itself, how well capitalized is it? Is it making profits at all? Can we see the accounts? If you're not making profits, actually, have you got equity on the balance sheet that allows you to go through this loss-making period to then get to cash break even and into profits and grow from there? What is the plan? So investors have to dig a bit deeper and really look at the fundamentals of that business, but also the people. Are these people actually well versed in the product set that they deal in? You look at the likes of Crowd Property, and they're good people. They've got the experience in actually building properties themselves and finishing these things off. So going on to the lending side becomes a little bit easier because they understand that whole process.
Yeah, and it's a difficult thing, isn't it? Because a lot of people don't have that necessarily the knowledge to be deep diving into a company especially somebody who wants to throw in £500 or just to get started, I just don't see them going through all that trouble trying to figure out, is this platform good or not? I think likely that they're probably just not going to invest at all, which is a shame for the industry as a whole in its growth phase, because we do need it and we want it to grow.
Yeah, but for those small investors, there are a lot of commentators out there that provide background and feedback, just like yourself, on the way that you've invested into these platforms and the performance of them, and where to look and what to do. So there is more behind there. It's if you haven't got the confidence to go and speak directly to a platform and say, can I see your set of accounts? And if you've never seen a set of accounts before, I'm a qualified accountant and sometimes I can't understand accounts. Yeah. It is a difficult area. So speak to people like yourselves and the other commentators that are out there to see how these platforms have performed.
So do you think, Andrew, that the FCA has failed in some degree of authorizing these companies to exist and them failing?
Is there a fence around here that I can sit on? I think the FCA had a very difficult time. The remit changed at a time when the financial markets were in a hell of a lot of transition. They were suddenly put into a position where they had to take on 50-odd thousand brokers and regulate all of them. They got the whole peer-to-peer sector, they got the whole e-money sector coming at them all at once. And this is an under-resourced regulator, and they find it very difficult. The markets are already 1-2 steps ahead of them. So the FCA is always playing catch-up, and I think they find it frustrating that they have to go through these processes. There's a consultation paper going on at the moment, and that will probably result in regulations that come in at the back end of 2022. So it's a 2-3 year process for them to understand where the market is and then to add further regulation to tighten things up. So they're always playing catch up, and I think they've got a very, very difficult job to do there. Especially when resources have been thrown at other sectors of the marketplace. Everything that was going on with the banks at the time, a lot of FCA resource and PRA resource was thrown at the banking world rather than at the alternative finance sector. So, yeah, I have sympathy for them.
Yeah, I think it's a thankless job to be working for the FCA right now. Certainly not a job I would want to take on. So what do you think of the current peer-to-peer lending market? Obviously, we've seen some contraction. What I see it happening is the cream rising to the top, especially through a difficult economic time of COVID. So it's showing us a lot about who can really survive. But what do you think of the current market the way it is right now? And then maybe what do you think about the future of where it's going to go?
So every new market goes through different phases. And 10 years ago, we had that growth phase, low barriers to entry, lots of people setting up platforms, and there was a race to become the biggest and get scale and get noticed. What we then entered into was the smaller ones falling by the wayside and closing down, which left probably 20 or so different platforms that had any sort of scale that could continue. What we then saw was the ones that got it horribly wrong suddenly collapsing. So we've already mentioned Lendy, Funding Secure, the House Crowd. And as you said, the cream's risen to the top. So the ones that were well set up and could survive a crisis like COVID, where the markets did change, then they should have a long-term future. Hopefully they have a long-term future. I'm a big advocate of this marketplace. I love peer-to-peer. It's formed 10 years of my life. So yeah, I want this marketplace to survive. And I think where the FCA put the regulations at the end of 2019 actually set a very solid framework for how these businesses should operate, with risk management frameworks, with solid credit policies, with the way that they report information through to investors. There shouldn't be a black box. This was all about transparency in the early days, that rather than putting your money in a bank and not understanding where it goes, actually you could choose where your money was going to, which project, which borrower. So that transparency has to remain. I think the FCA have done a good job in shaping that. longer term for the future, I'm worried that the FCA are going to go a step too far and take out the restricted investor class from the peer-to-peer marketplace, so that you can only be a sophisticated investor or a high net worth investing into this asset class. And I think that's wrong. Restricted investors could go and buy shares on the stock market, and shares go up and down. At least with peer-to-peer, there should be a return that comes back from it, and very little losses going forward. So I think to take it away completely is wrong, but I think there should be more controls around the restricted investor to make sure that they don't put all their life savings into that. I used to call it the granny principle. You don't want Granny Goggins from the Highlands putting £10,000 of a life savings into a loan, and it goes wrong and she loses it, because you're all over the front of the Daily Mail, and that's where nobody wants to be. Would you trust your granny actually putting her life savings into a product? And if the answer is yes, then great, you're doing the right thing. If the answer is, well, I think it's a bit risky, then we've got to change that risk level to a more acceptable point. And that's where the future needs to go for peer-to-peer, that it has to focus on this risk management to make sure that those vulnerable investors don't end up in a funding secure, in a lending position and losing hundreds of millions.
Yeah. I wouldn't have entrusted my granny to invest in premium bonds. She had the worst luck on the planet, and so definitely not. But I totally agree with you, and I think that's one of the problems is if you leave people to their own devices, they can make some terrible decisions. But isn't that the idea of like free choice, that we can allow people to walk into casinos, right, and drop all their life savings on a roulette wheel, but if they decide that they want to invest some money into cryptocurrency or a peer-to-peer loan, then the FCA now all of a sudden is, no, you're not allowed to do that. And there's just such an inequality with the rules and regulations about different types of sectors and industries I found very annoying.
I'm a believer in free markets. I'm a believer in, I'm a capitalist. I've set my own business up. I've worked in the finance world all my career. So I do believe in those free markets, but likewise, there are some unscrupulous people out there. Casinos generally are regulated, and if somebody wants to go and blow their money, then that's up to them. The casinos are probably monitoring them to make sure that they don't go too far, but still doesn't stop these things from happening. But there are some unscrupulous practices. We've seen in Asian countries and in places like China where peer-to-peer lenders were set up, and then people have disappeared with several £100 million worth of investments and never to be seen again. We certainly don't want that to happen. So I'm a fan of regulation to stop that. But likewise, I do believe that the restricted investors should be allowed to make that decision of where they invest, but the platforms have to make sure that what they're doing does protect those restricted investors, so we don't get those scandals coming through again. There will be losses. If you lend enough money, you should lose some along the way. That's the nature of lending. And if you don't lose money, you're not taking enough risk. But what you shouldn't do is end up with a complete loss in lending. That's wrong. You should end up with a nice level of return coming back.
Yeah, I agree. And for everybody who's watching out there right now live, if you have questions, put them in the chat. We'll do a Q&A at the end. Hopefully Andrew will hang out long enough to do that. So ask away, and I'll present the questions to him, and it's up to him if he wants to answer them or not. Maybe he'll say no. I'm sure he will. So
be gentle.
Yes, they will. Everybody's very nice here. We have a regular bunch of people who tend to tune in. We got people watching from Greece and Spain and all over right now, so just don't get too nervous. And for anybody that came in kind of late, because I know some people weren't here right at the beginning, you had mentioned some of the platforms that you thought currently are doing a good job within the peer-to-peer lending space. Can you just go through those ones that you think are doing well right now? And
the three in the UK that I like, Able Rate, I think they've got some of the more interesting loans out there. I wouldn't say they're the most perfect loans, but the way that they handle them and deal with them, I like the way that they operate. Crowd Property, undertaking development finance loans. I think the model that they have developed for undertaking development finance is absolutely spot on. And I really like them as a business. I think it speaks volumes as well that I think they landed 300 million of institutional funding recently as well. So that sort of rubber stamps them as a business. If somebody's prepared to put that level of finance behind them, then they're doing something right. And then PropLend, I really like the way that PropLend operates and what they're doing. So they're the three that I probably have a softer spot for at the moment.
Okay, and also if you're watching, please remember to hit that thumbs up so we can trick the YouTube algorithm into thinking that this is a really great and interesting stream, which it is. We don't have to trick them. So hit that thumbs up button if you haven't, and subscribe to the channel. Okay, so one of the concerning things that I see within peer-to-peer lending is that a lot of the companies are running in the red and have been for a long time. Is that concerning to you as somebody that's obviously is quite experienced in this sector of finance?
Yeah, and again, I'll put my accountancy hat on again now. So losses aren't necessarily a bad thing. Losses are okay as long as you have a capital base strong enough to absorb them and you have enough cash. So cash is what governs how a business survives. If you run out of cash and you can't pay anybody, then it's game over. You only have to look at the likes of Amazon is a great example that ran at a loss for years, almost a decade it ran at a loss for, but it had enough cash on its balance sheet to continue its growth and development to the point where it could not make cash, if that makes sense. And now it's just a huge cash cow. That thing is generating so much cash, it's ridiculous. But it had the capital base to allow it to grow and develop. So losses aren't necessarily a bad thing. And I think you have to differentiate within the cost base, actually, what is their underlying trading performance and what are the non-trading costs that are in there. So there may be research and development, there may be recruitment costs as the business grows that are non-recurring. These things happen once and then they don't happen again. So I think what we don't see in a set of accounts is actually the split out of those costs and the analysis of that as to what's going on. So the balance sheet becomes a lot more important. Have these businesses raised enough equity? And we've seen a number of businesses go through fundraisers with seeders, and there's other equity houses out there putting cash into it. Funding Circle is another classic example here that has been loss-making for 10 years or so and is now starting to make a profit because they've hit that critical scale. But that was always the plan for that business. It was always a VC play. It was funding round after funding round after funding round, float the business, continue the growth, and then it moves into profitability. So I'm not overly concerned about losses as such. Where I would be more concerned is where the losses are unsustainable because the capital base, the equity that platform's got, can't sustain those losses for the longer term.
Mm-hmm. What do you think, speaking of Funding Circle, do you think they're going to open up back to retail peer-to-peer lending, or is it going to be it for them? Because I have a suspicion that they will not do that.
Why would they?
Exactly. Retail lenders are such a pain in the butt, myself included.
No, I loved my customers in my business. Some of them were difficult to deal with, and we always tried to promote an ethos of great customer service, of listening to what they wanted and making sure that we looked after them. But yeah, it's difficult. It's the same for the retail banks. They've got thousands upon thousands of customers, each with individual and different needs. But the money that you make from those very small customers is tiny. And it's only because you've got a huge volume of them that you're actually able to generate any profit at all. So it's hard work. Dealing with 10,000, 50,000 retail customers is very, very hard work. Funding Circle are in a very different place. They don't necessarily need those investors to come back. They're doing perfectly well without the retail crowd. So why would they bring them back? And it seems a shame that one of the pioneers in the industry probably isn't going to come back.
Yeah. And I think that the big ones are obviously Rate Setter's gone, Institution, and then Zopa. Who knows what's going to happen with them? And then Funding Circle will be the third that I think will disappear from retail completely. But a lot of people in the stream are always saying that they've not done well with Funding Circle. They have a ton of defaults on their loan books, but you can't win them all, right? When it comes to this
Absolutely,
investing
absolutely.
game. So now I have to change the subject a little bit. I'm a big believer in the cryptocurrency space, and a lot of people who we have a Facebook group, and some people are very old school in their investing mentality, and I hear the words Ponzi scheme, scam, all this kind of stuff cropping up. So, what are your thoughts on cryptocurrency? Is that something you invest in?
I have a small investment in crypto. I've started to follow it a little bit more in the last 12, 18 months or so. It's an interesting space. I'm a big believer in blockchain. I think what blockchain can do and the way that it can help regulate lending in the future, especially peer-to-peer, the immutable ledgers, will help when loan parts are being intertraded between investors. So I'm a big believer in blockchain, but crypto itself, when you look at traditional currencies, they have an underlying asset. It's the country where that currency comes from that is the asset. How that country performs dictates on what the value of that currency actually is. When you look at any other investment class, there is an underlying asset. Gold, you're buying a solid piece of metal, stocks and shares, that there's a business behind it. Whereas with crypto, it's a bit more intangible. It's very hard to say exactly what goes behind something like Bitcoin, or what goes behind Doge, or what goes behind Cardano, or something like that. There's some very interesting models out there, and people like I've forgotten what they're called now. I think the ticker for it's ADA. They're looking at trying to do interesting things in Africa, and I think that's really where crypto could become very interesting. Is where financial markets don't work efficiently, and it can transform those financial markets. But there's a long way to go with it. So at the moment, I'm watching, but I'm not fully into it.
I totally understand. Yeah, what I've been actually doing some research on the adoption rate of cryptocurrency and how some of these companies have grown. I'm sure you've heard of Coinbase, but there are over 65 million accounts now in Coinbase, and if you compare that to say Fidelity, which is an institution that's been around since the late 1940s, now has about 26 or 27 million accounts. And that's pretty astounding if you consider that Coinbase we're talking about within the last, within a decade that they've been able to grow. And these companies like Binance, some of these smart contract companies like ADA, that they've exponentially grown so fast in such a short period of time. And when I started to really dig into what these companies were actually doing, and when you say, there's some things are not very tangible, like Bitcoin, you can't really figure out where is the value in it. You can't hold it. But if you look at some of the companies that are actually, utilizing this technology, there's so much legs behind the asset class in general that we're in such an early stage. But I'm going to predict to you, I'm going to make this prediction now, that by mid-2025, you're going to have, I would say, 1 billion people that are going to be utilizing cryptocurrency as an asset class. So that kind of growth is crazy.
Yeah, it is. And I am a latecomer to it. I mean, I was watching it for the last decade or so as Bitcoin grows. We've all heard the story about somebody who's paid 3 Bitcoins for a slice of pizza, and it's the most expensive pizza in the world now. But for things like, say you're a trader in somewhere in Central Africa, and you're trying to trade with somebody in South America. Okay, you've got all the shipping issues and everything else to deal with, but the currency that the African may be using against the currency that's in South America, there could be a whole host of different issues. But if you can talk in Bitcoin, or you can talk in Dogecoin or something like that, suddenly you now have a common currency that everybody understands the value at their point of where they're located. and it can be transferred like that. It's so much easier to undertake the business with crypto. So that should improve the global trade. The issue that then comes is, and this is where governments are probably spending a lot of time at the moment, how do you monitor those flows? How do you control that? Because where's the tax then paid? Mm-hmm. Because this payment's been made up here somewhere in the cloud. And how do you track it? How do you know that that payment has actually been made, and who pays the tax where? And without tax income, then civilization starts to crumble, because who's going to pay for the roads? Who pays for infrastructure networks? Who pays for hospitals? And that becomes a big worry for the future. So I think crypto does play a place, but then it comes down to what are governments going to do about it, and I don't think anybody's got any idea as to what they're going to do at the moment.
No, and I've sort of flipped the way that I think about regulation. I used to think, we just don't want this asset class regulated, but what I've come to realize is that all the government cares about is collecting the taxes and making sure that money laundering is not going on beneath their noses. So if the governments can figure out a way to take care of the regulation on that side in a correct way, my fear is that governments over-regulate everything because they like to keep things into the hands of the wealthy. But one thing that it may do is, if there's less tax money coming in, maybe the governments will stop overspending in a reckless manner like they've been doing for so many decades. And all this money printing is a massive problem now economically. Maybe it will take care of that. Who knows? We'll see.
You never know. You never know.
You never know. You never know. We've got a couple of questions here that I'm going to kind of go through and see if there's anything interesting here. Paul New said he wants to know, what was your worst investment that you ever made in something?
RBS shares. So I worked for RBS for 10 years, and you were always incentivized to take the options that came along and reinvest bonuses into shares. And just before the financial crisis, I had probably about £150,000 worth of RBS shares, and within the space of 3 days they went down to about 1,500. So yeah, that's probably my worst investment, and a level of naivety probably from myself that I put so much into RBS itself. I worked there. I really enjoyed the bank. There was a good working environment there. They did look after you, regardless of how much they screwed up the world, or one part of that bank screwed up the world. The underlying commercial bank that I worked for was a good place to work. It was an enjoyable place, but yeah, I put too much into RBS, and I lost 150 grand in share value in a matter of days, which was very, very painful.
Yeah, so lesson learned out there, people. If you work for a company and they offer you share options, don't take them. Just take that money and invest it yourself. 'Cause I get actually that question asked a lot about whether, a lot of people are, some reason they think that they should be investing money in the company that they're working in the shares, and I'm saying no, it's not usually a good idea. So make sure you diversify.
Yeah, it was a cheaper way of actually raising equity and getting cash back into the business by offering it to the staff. And wise head on my shoulders now can see that, but who could have expected that the bank would have gone through that particular crash? It came very quickly when it happened, but yeah, just diversify your portfolio, spread the risk, and that's where I am today. Yeah, I've got property investments, I've got some shares, I've got my pension pot, which is mainly in conservative investments, but there's a few more moderate and high risk investments in there. And then if I've got spare cash, I'll put it into P2P for a while and get a better return on it.
And don't forget to keep buying a little bit of Bitcoin, because you'll thank me in 10 years. I promise you'll come back and say, God, that was the best thing you ever told me. I'm
not sure about Bitcoin. There's a few of the other ones, the sort of second tier, that seem quite interesting. Ripple, Doge, and one or two others. Having said that, Ripple's probably one of my worst investments. I'm about 50% down on that, but I think that's about £15 that I've lost on there, so it's not huge.
You'd have a lot, yeah. If they can beat this lawsuit, maybe they'll be okay. I'm not not convinced about the Ripple. I have a friend who's a diehard Ripple XRP holder, and the problem is they have billions and billions of coins that can be dumped onto the market at any time, but we don't know what's going to happen. Mike Powell wants to know, do you have any connection to Carl Davis, who also turns up in relation to Funding Secure in the house crowd?
Yes, it's same Carl Davis. So I met Carl through Funding Secure. So Carl was brought in as part of the new management team. He'd worked with the guy who bought the business. He'd worked with him for a number of years. So Carl's a very safe pair of hands. His background, funnily enough, it isn't actually in lending. He's actually come from an FMCG background, and he'll quite happily tell you that he launched Wash and Go as one of his first projects with Procter and Gamble, which I always find quite fascinating. It's quite an iconic product that was around sort of 20, 30 years ago. So Carl's very good on systems and processes and making these things work. What I brought was the technical expertise around the lending and the actual peer-to-peer side, having managed my own business. So yeah, Carl came across with me from Funding Secure over to the house crowd. As I said, we've got a plan together to we stopped lending for a while whilst we worked out what was in the portfolio. We've got a plan ready to go to start lending again, and then COVID came along, and unfortunately the business failed sort of 6-7 months later.
Just in your opinion, how are investors going to fare in this house crowd administration?
It depends which loans you're in. There are some of the loans, certainly the bridging book. There will be losses. There will be some losses, but I think most investors should come away with most of their cash, if not all of their cash, depending on which loans they were in and the position that those recoveries are taking place. The development side's a little bit more troubling. I think that's been mentioned by the administrator as well, and I'm still retained by the administrator, so I'm helping to unwind this book at the moment and working with them. So there's some things I can't say, but I think they've been very clear on some of these developments, that processes that were put in place hadn't worked before the administration. There'll be some unwinding. I think there will be losses that come out of the development finance side.
So it should have been a clue that if something was named the Downs, that your probably cash was going to be going down, maybe. So I know you can't comment on that. So
I can't comment. I'll just sit here and smile.
Also, Mike had a comment that I thought was interesting. He says the problem with the FCA is it makes the rules but can't and won't enforce them. Lots of platforms are margined in their compliance with some of the disclosure rules. What do you think about that?
I know the P2P team quite well at the FCA, and they do know the rules. And I think where they are at the moment, they've got a lot of platforms that are trading. And what they don't want to do is rock the boat too much and cause another failure to happen. But likewise, there's a lot of marginal platforms out there that maybe haven't started trading, where there are certain VRECs in place, or they will, and this comes from experience of working with the FCA. The FCA are very good at giving you direction, which is almost an open question. And when you answer that question, they come back with 3 or 4 more open questions, to the point where they can just keep kicking this can down the road and stopping you from performing. I do agree that they haven't yet taken action against anybody within the industry, but we've got to wait to see what happens with the lending administration. We've got to wait to see what happens with Funding Secure. It's well known within Funding Secure around the ARC loans and what's happened there. House crowd, don't know. Let's see what happens. But those administrations have got to wash through to the point where the administrator actually provides a report to the Secretary of State for Business that says how those directors have performed and actually what has happened. And only then could actions be taken against these individuals.
Yeah, that makes a lot of sense. So Robert Pates, who I believe is watching from the sunny country of Greece, where the weather is glorious all the time, said, if you believe blockchain is good, Andrew, how can we, if all, invest in purely that? So maybe what he's saying is, instead of buying the coins, the cryptocurrency itself, is there a way to invest in the actual blockchain technology that you know?
So, a good question. There are businesses out there that are building on the back of blockchain. So let's go back to Able Rates, because the team at Able Rate have built something called ASMX, which is it's almost like a stock market for loan units. And that's built off the back of blockchain technology. So Ethereum is the underlying mechanism and the blockchain that it's built upon. And they're using that to good effect to actually build a stock market effectively and undertake those trades and have a ledger of who holds what at what price and what date it was bought, etc. So you could actually invest into somebody like ASMX that's using blockchain technology to the best that they can do. But the blockchains themselves, really the value in them comes back to those coins that get produced, and you have to buy the coins. And it's almost like the Wild West. Some days you can see coins rocket 100%, 200% because Elon Musk decides to tweet the name. And if you happen to see the tweet in the second it goes out, you can make a killing. If you don't see it, and you buy at a later date, then you could be on the downside of it. So it's difficult. There's no businesses there really that have floated on any particular market where you can go and buy their stock, actual tangible stock in those businesses, because all of this is at the moment is, as Ethereum says, it's almost ethereal. It's yet to be solidified into something more tangible.
Yeah, absolutely. Hey, and I'll tell you one thing that the blockchain could have solved is one of these issues of when the administrators had come into a company that had failed and they couldn't figure out who owned what. The blockchain would have been a perfect example of solving that problem. Absolutely. And saving a bunch of money on
Absolutely, and that's where I think blockchain has that value for complex things like that. And you look at some of the platforms that are there, even things that I put together in my business, where you have these investment accounts where multiple people are coming into that account, and there's intertrading going on a daily basis, plus there's new loan assets coming into there and falling out of it on a regular basis. That's where blockchain could have real value for tracking all of that and actually saying this is who owns what at this particular time.
Yeah, absolutely. Mark B has an interesting comment. He says he thinks the peer-to-peer lending market in the UK has gone through and is going through what the crypto space is going to go through now. If the FCA regulation is strong, I hope they encourage innovation. Now, what I've been hearing from people that have been trying to get regulated through the FCA, who are trying to create new peer-to-peer lending businesses, they found it extremely difficult to get through the regulation process. So is the FCA encouraging new companies to come into this space, or are they saying, well, we've kind of cocked things up in the past, so maybe we want to really limit new companies coming into the space?
I think they have more than enough on their plate to deal with what they've got. So are they actively stopping innovation and stopping new platforms coming through? I'm not sure they are. So I think they have to show that they are working with those platforms, but I think they're making it more difficult for them to go through that process. It would take, from a fresh application today, as long as you had all your documents lined up and ready to go, so you had a risk management framework, you had a wind down plan, you had your resolution manual, you got all your credit documents in place, you got your lender terms and conditions, and 101 other things that you need to put that application in, it would still take 12 months to get a license from the FCA on their current workflows. If you haven't got those things in place, you're talking 18 months, 2 years, because the FCA will just keep coming back and asking more and more questions, and it will naturally take longer. So again, I think it comes back to resources within the FCA. They haven't got the resource to deal with everything that they've got to then allow new platforms to come through. In terms of innovation, I'm not sure what else can be innovated within peer-to-peer at the moment, apart from better risk controls for investors, or something on that blockchain. Again, I'll come back to ASMX because I really like what the guys have done with it. Could ASMX actually connect all of these different platforms together so that you've got an open marketplace where you can start to bid on different loans from different platforms with different borrowers in different countries?
Mm-hmm.
Let's add in crypto to that. Rather than saying, well, that loan's in euros and I've got pounds, and there's loans over there in dollars, and then there's some in Australian dollars. Actually, if you converted everything into crypto, that gives you now a common currency that you can actually deal on, and you understand the value of that from what you know that value of the crypto to be. And so that's the innovation that I think could come. Would the FCA allow that? At the moment, I couldn't see them allowing that sort of innovation to come through. They're so worried about what has happened in the past. They don't want that fourth or fifth platform to fail that puts even more egg onto the face.
Okay, so I'm going to put you on the spot here with a question from Chris. You can answer this if you want. You can politely decline if you don't want to answer the question. But Chris said, what do you think about Kuflink?
To be honest, I don't know enough about them. I always get worried. Lendy advertised for Cows Week and back sporting events. So whenever a peer-to-peer platform is relatively small, is suddenly advertising on a Premier League game for Southampton, it makes you wonder why have they got so much money that they can throw around to advertise in that way when they're still relatively small. So that would be a concern in itself. Then there seems to have been issues with the FCA, which the CEO has said that they've been resolved now, and they've got a clean bill of health. But it puts up a warning sign, and if you're new to this marketplace, it's a sort of warning sign you should take heed of and just wait and see. If the CEO is right and he has resolved all of these issues, then great. They can carry on. If it's just a bit of fluff and actually those things haven't been resolved fully, then that would be a concern. Sorry, I'm sitting on the fence a little bit here,
okay.
But I don't know enough about Kuflink to really comment on them. But it is a warning sign, and I think it's a case of waiting and seeing to see where they end up.
Yeah, and it's so hard because we just really don't know what goes on in the back ends of these companies in any cases, unless you're the owners of the company or the accountants back there. That's the only way you really know. So we have to go on the faith of what the people who are running the companies tell us as investors, which can make things quite tricky, right? And it's just the way it is.
Absolutely, and it comes back to that transparency point. These businesses are, or should be, allowing you to see through the platform to the underlying assets that you're putting your cash into. But they should also be open and honest about the performance of the business as well. And the FCA has tried to do that with loan book statistics and a few other metrics. The details on what happens if a platform goes into a wind down, what happens with your cash and all that. But it should go another step further, really, in my view, that you actually get to see, is this business capitalized in the right way? And this is something the FCA are focusing on. There have been a lot of questions to platforms that I've worked with around their capital adequacy. Can they survive another COVID? Can they survive a downturn in their business? And that should be more transparent so that investors can see that.
Yeah, totally agree. Okay, so I've just thought of this all of a sudden. I'm going to start asking people who come on the stream, and it's going to be called, what would you do with 10 grand? So if you had 10 grand today of your own hard-earned cash, where would you invest it?
I've developed quite recently a fondness for watches, and I've started to look at that marketplace a little bit more. I'm finding it fascinating. I think I'm coming back to these tangible things again, and whilst I'm a believer in crypto and where it's going at the moment, it's that intangibility that makes me a little bit nervous. But yeah, I've started to get interested in sort of timepieces and There's some investing for the future on those. I think newer watches that are coming along that are limited edition runs, if you can get in and buy those early, then longer term they could become quite valuable. So that's something I've gone for recently. I think another area that's becoming quite interested is digital art and NFTs, non-fungible tokens. We've seen recently where one sold for several tens of millions and made the guy very wealthy overnight. That's becoming quite interesting. But again, I don't know enough about art to then say, well, that guy's really good and he's going to be worth something in the future, to then invest into that. So yeah. I tend to stick to what I know.
And I don't know if you know this, but there was this is how smart contracts are being utilized, but there apparently is a piece of code inside the ownership of that art that you're talking about, is from a guy named Beeple, that he is paid, I think it's a 20% commission every time that piece of art is resold. So I found that quite fascinating, that he would be able to be paid a royalty over and over and over again if that gets turned and flipped again and again. So that's one of the things that smart contracts can do, and I think that's a very interesting
that could be quite interesting is then into the music industry, where you stream an artist on Spotify, they get paid on a pro rata basis based on the number of streams that happen. Whereas I've forgotten which streaming service did it recently. Was it SoundCloud? Have released a Portishead track which made them 500 times more than they would have done if they'd have put it onto the likes of Spotify. And again, that comes back to changing the royalties model, but maybe an NFT could create that sort of resale value for them, that they get paid every time this thing is played. So technology is fascinating as to where it's going and what it could do.
Yeah, and it's from what I understand, musicians, they only get paid about 20% of if they release an album. The middlemen take out those chunks, and having these NFTs and tokenizing their music is going to be able to have them be paid a lot more money, which is very interesting. So 10 grand on Casio calculator watches and maybe some NFTs. Okay, I like that. That's an I wouldn't have pictured you for the watch guy, but I'm a watch fan of myself. Let's see if there's any other questions here. Paul New says, pop this up on the screen. Very worrying about the latest inflation figures in the UK, up about 50% this month. I'm presuming 50% month over month from last month. What are your thoughts on this inflation surge that we're seeing?
I think there's two factors that are driving it. One was, I'm going to say the B word, Brexit has had an impact. Brexit was always going to have an impact, because there will be a 1 to 2 year period where everybody got used to how goods are now going to come into the country. And we lost employees back to Eastern European countries. So we've all heard about fruit rotting in the fields, etc. And what that has done has increased wages. And with increased wages, people can afford more, or prices go up anyway, because it's a cost to a business, so prices have to go up if wages go up. So that's always going to drive inflationary figures. The increased cost of actually getting goods into the UK is going to drive inflationary figures up as well. But we've also come through a period where the economy's been stymied because of COVID and because of the restrictions that have been put in place. And we're only just coming out of that period. It's only 2 months since we actually had all those restrictions lifted. The economy is now starting to get supercharged again. Prices will go up. Losses have been made by these businesses, and to recover those losses, they have to put prices up. There's been an increased cost of managing a business just because of COVID. So I'm not overly worried that there's a spike in inflation at the moment. Where I would get worried is if that continues for 3, 6 to 9 months, what can governments do? And governments can do very little. Interest rates are so low that they're practically zero. You mentioned before about bond markets have just been awash with cash, and there's no returns on there. So quantitative easing probably isn't an option for the government as well, and that then starts to become a real issue. So not overly worried at the moment, but if it becomes a longer term trend, then yes, I'd start to become more worried.
Yeah, and I figured at this point they cannot stop the money printing now. They're so entrenched into keeping this market propped up with all this money that's being put into, treasury bonds and stuff in the US, that right now their sort of hands are tied. And if they stop this easing, the economy just collapses. I think it's a big problem. So we'll see. I think the inflation is a big issue, and I think it's going to get higher and continue to go up. And even if you look at the narrative of, say, what's going on in the US, I always look at the US as sort of watch what happens in the US, and everything else tends to kind of crumble behind the US, like what happened in 2008. And I see this narrative right now of the media saying everything is fine, the economy's doing well, the stock market's okay, but in the background, the inflation is continuing to rise up, and the money printing is continuing to increase these huge deficits that are just getting out of control. And I thought this was really interesting. I don't know if you spotted this story, but there's some government regulation in the US that is going to automatically default people into 401k investments. So if you work for a company in America, they give you an option of whether you want to 401k invest. And I think the default is set to no. But now they want to put in this regulation to say that every single person is going to be defaulted into a yes on their 401k pension. The thing that's really interesting about that is that your Social Security in the US is going to run out. So what the government's saying is, oh crap, we're not going to be able to pay Social Security out. We need people to start privately investing, because we don't know how we're going to pay people's pensions on the Social Security plan. And I see all of these problems kind of bubbling up in the cauldron of what the Fed has done in the US, and it's just going to have a terrible impact in the future. We'll see if that's true or not.
Yeah, I think the issues, as I said before, that the governments have got very few tools left now to manage inflation, and we've had 20 years of mismanagement of economies. The political class that you look at now, and the size of government. We have a Tory party in power, and Tories are supposed to believe in a small state and low taxation. And they're just increasing the size of the state. We've had the most left-wing policies through the COVID period that I can ever remember. I grew up in the late 70s, early 80s, and into the 90s. So I know what it's like to go through a number of recessions and actually sit under a Labour government. But things like furlough is the most left-wing policy that you could ever imagine. Actually paying people to sit at home and not work. It's unbelievable. Mm-hmm. The way that the banks were saved, and the businesses, the banks were encouraged to save businesses. So we've ended up with a lot of companies carrying far too much debt, and they can only afford it because interest rates are so low. So you've almost got these ghost companies. I think what will happen with the back of things like bounce back loans and C-bills is a lot of companies have shifted away from their traditional bank debt, refinanced onto a C-bills loan, and they could quite happily collapse their business now, and the government picks up the tab, re-phoenix it, start again, the business is fresh, it's not debt-laden anymore, and off they go. And that's a big worry as we come out of this period. If inflation does continue and costs do start to rise, the defaults within C-bills and these government-backed loans will continue to rise, and the government's going to pick up the tab. We've already got a huge state and a huge national debt. That's only going to get bigger.
Mm-hmm. Yeah, absolutely. I think this is exactly what's going to happen, for sure. 100%. I don't see how these companies can.
I hope not.
I don't see how the companies can continue to pay the debt if the interest rates rise. It's just going to be a big problem. So the governments cannot put rates up. So everything is just handcuffed at the moment. But we're gonna. I know you've been on for about an hour and 15 minutes. We're gonna have a couple more questions. I'm going to let you plug whatever you want to plug if there's anything you want to do. Mark B says, do you see another financial downturn coming in the near future, you have to look at your crystal ball. And is there any way to protect investors or ourselves against such events apart from going to cash for a while?
There will be one. Will there be one in the near future? I'm surprised. Well, no, the economy has turned down through COVID, but this hasn't been a natural downturn. This has been enforced upon us because of the actions of governments. If they don't control the way that we come out of this period, then there could be another serious financial crash at some point in the near future, within a 5-year time frame. It's very difficult to predict because we are in a period of unknowns at the moment. This is the first time that the economy has been in such a position because of global enforced restrictions due to COVID. We've never been here before, so we don't know how to come out of a situation like this, and that's going to be quite interesting. How can investors protect themselves? Again, due diligence. Keep reading. Keep looking at the economic factors that are coming through. A good dollop of pessimism is always good in there. People used to call me a cynic when I was looking at credit proposals and trying to find everything that could go wrong with it, because I wanted to know where the possible downfalls were and what could go wrong and what the outcome could be. So you've got to ask those questions. Are the markets moving in the right way? Where are interest rates going? Where's inflation going? So there's a whole host of factors to look at, but just keep reading and keep looking at what the commentators are saying, because generally the commentators do get it right, that they can see these things are about to happen.
Yeah. So my take on it very quickly is this is what I see. As long as the interest rates on the Treasury, like the U.S. Treasury 10-year, stays low, I think that's a pretty good indication of what happens to the stock markets. And the more bad economic news we get is actually really good for the market, because it means that the governments cannot stop this money printing. When we start to get good economic news, I think then the governments will start to look at, can we pull back on the printing? That's when the markets, I think, are going to experience some troubles. And so as far as things stand right now, I don't think the stock market... I made a mistake. I pulled my money out of the markets about 4 or 5 weeks ago, thinking that things were looking very, very dire. But after analyzing it again, I think that was a big mistake, and I don't think the markets are going to suffer anytime soon, because the governments cannot afford to have a stock market crash right now. So they'll do everything they can to keep them up. With also crude oil prices staying high. So we'll see. I have a crystal ball here, Andrew, and if you haven't seen this, it's very accurate. There's a 96.2% accuracy of being correct. So anyway, let's I think we're going to wrap things up, because you've been very gracious with your time. And do you want to tell us a little bit about, like, Inquivito? Did I say the equity? Say it for me. Equitivo. Is there anything that you want to tell people who are watching about your company and what you do, to have a plug or whatnot?
Well, I mean, it's not something that they can directly invest in. It is a service company that helps platforms, and we're trying to make the market better. Everything that I do is in the interest of those investors. How can we improve those systems and processes to add the protection layers in that they need? And I've worked with a number of platforms to try and help them and improve them and let them grow in a more sustained way. ESG is quite a big thing now in the corporate world, all about sustainability and good governance, and quite rightly so. And whilst I'm a capitalist, there is a slight socialist element to me as well. I think business can do great things in making everybody's lives better, and more business people should give back a little bit more. That's for another time. Let's not get into politics tonight. But yeah, that's really what Equitivo's doing. there'll be some interesting news over the next couple of weeks as a number of things that we've been working on are coming to fruition. So helping these platforms get the institutional money that they need. So that there's a number of deals that we've been working on there for quite a while now. Everything slowed down through COVID, which I should have been grateful that I was having another holiday, but a little bit frustrating that I'd started down this route and then got stopped again. But yeah, if anybody's ever got any concerns or questions, find me on LinkedIn. Quite happy to have a chat to people and give my views on where the market is.
Well, very much appreciated. We've got a ton of comments here, people saying thank you. They've really enjoyed listening to your thoughts on what's going on in the peer-to-peer lending market, and hopefully people watching in the future can re-watch this again and really understand some of the things that you've been talking about. So thank you very much. Would love to have you back on.
My pleasure.
In the future. We can do like a little market update every now and again if you have the time.
I'm not sure I'll watch myself back, because every time I watch myself, I always sound very northern. You always sound different to how you hear it in your own head, and I hate watching myself back on these things.
Nobody likes the way that they sound, right?
No.
Apparently that's the way. But thank you again, and best of luck with your business, and I hope it brings in lots of money so you can buy more watches and
Thank you
things
very
that you're
much.
interested in. And we'll speak to you again soon. Okay,
Great
thanks,
stuff.
Andrew.
Thanks, guys.
Thanks. So there you have it. That's Mr. Andrew Holgate, former co-founder of one of the big five that's on my top 5 list. We had a good chat with him about the peer-to-peer. You can go back and watch it if you missed it. Go back and rewatch and listen to what he's talking about, his involvement in trying to help funding secure in the house crowd. Very fascinating, very fascinating. I've been wanting to get Andrew on for a while. We're going to do a quick crypto update and look what's going on in the market. We've seen some movement over the last few days. You can see here, let's look today, Bitcoin's up about 2.25%, Ethereum 3.16% up. So I think things are generally moving in the right direction, but one of the questions that I get asked a lot is it a good time to buy into Bitcoin? And I wanted to show you one of the indicators that I think is good to look at if you're kind of inexperienced and you want to try to figure out if it's a good time. Right here, hopefully you can see this. There is a thing, if you go to Google the Fear and Greed Index, this is it's a very, very, I think, accurate indicator of whether it's a good time to buy into Bitcoin. And what I found in past history, again, not financial advice, but anytime this needle is in the red, so right now it's 53, it's neutral. Anytime it's in the red on this side, it's generally a fearful time when a lot of people are selling and the prices are falling. And at the times when Bitcoin has been at its highest, we've seen this number over here on the right, in the green side, up to 70, 80, or 90. So right now we're at a completely neutral stage. So theoretically, you should just see the price of Bitcoin sort of trade sideways for now. But as you can see right now, we saw the greed index last month was at 72. That was when the price of Bitcoin was higher. So if you see this sort of dipping into the red, and you can check it once a day, it doesn't change every minute or every hour. It's something that's looked at daily. If you see it in the red in this indicator here on the left, it's generally a pretty good indication that the prices are heading south, and good time to pick up some Bitcoin at a discount. So markets generally had a pretty positive last few days. Now you can see the total market cap now on $2.1 trillion in the cryptocurrency market, and exponentially this is just going to continue to grow. We're seeing an adoption rate of well over 100% a year annually, over 200 million users of cryptocurrency right now. I think you're going to see this number just continue to increase. Again, I'm a big believer, again, not financial advice, but we're coming up on this $900 billion market cap. So if we look at some of the 7 days, we've had some pullbacks here. Solana is down 16%. They've had a couple of issues this week, their network going down, but you can see Polkadot is up 15% for the 7-day period. So very, very interesting in what's going on. You can still pick up some of these coins at a discount too if it's something you're interested in looking into. Polkadot right now, again, not a bad time to buy. Solana is trading a lot lower than what it was. You can see here the 7-day chart. It was close to 200. Oh, actually went over 200. Oh, did it go over 200? I think it was at one point I saw it go over 200 and it was down as low as 147. So there is an opportunity to buy at a discount now too. So the market generally doing pretty well, and I can see it is going to go a lot higher. I am a big believer in that. No matter what the people say out there, the naysayers of Bitcoin, they will say negative things. But one other thing to look at, Trading 212 portfolio. I'm in a bit of a difficult situation with this portfolio at the moment because I keep looking at the markets thinking, wow, they're very toppy, and I'm looking for some kind of a pullback to be able to go back in, deploy this money that's been sitting on the sidelines, and through the errors of mistiming have not been able to do that. But the portfolio is continuing to do pretty well. We're up at a value of almost £13,500. We've had a really good week with Laredo Petroleum, and annoyed at myself because another error that I made with this stock was I had a fill order set that I'd completely forgotten about because I was not paying attention, and it executed at 61 US dollars. You can see here that it's now $70, so it executed down when the market was dipping. I think it was right down here on September the 13th, or maybe even a little bit earlier, the 8th or something like that. And if I'd have spotted it, I would have canceled the order, but it went ahead and sold at 61. I think I bought it down here at 58. I was trying to short-term trade, and now, of course, the price is starting to surge again as crude oil is now back over 70 US dollars a barrel. But again, sitting on the sidelines, I mean, this Centrus Energy stock has started to really take off. We're up 38% on that. This is a new position in Facebook. This was a very long-term position, small position, but it's a little bit in the red. Lloyd's Bank starting to claw back a little bit, so we'll see what happens with that. I would really want to get this money redeployed back into the markets. We've got £7,948 in cash, looking for a pullback. I was hoping that crude oil would pull back, but it just hasn't, to the point where I was going to jump back in. This is the problems again with market timing. When you're trying to time, the emotions get involved. It happens to the best of us, myself included. And trying to find that point to come back in has been quite difficult, but we'll continue to look at that. We're going to wrap this up. Been going on way too long. Thank you to everybody who joined on the stream. I hope you enjoyed Andrew's insight. We couldn't really talk about the company that he was involved in, that he co-founded, because they have some legal agreements about discussion of that, but we still had a good discussion nonetheless. And big news, October, I'm probably going to give you the wrong date. I think it's the 7th, October the 7th. We're going to have Louis from LoanPad. Yep, October the 7th, he is committed to being on the stream live. Louis Schwartz, CEO of LoanPad, is going to be here live. So put it on your calendars. Tell all your friends and family to be here to tune in. One of my favorite peer-to-peer lending companies. And thank you to Kuflink for sponsoring this stream. Sign up today and receive up to £4,000 cash back on your first investments. Terms and conditions apply. Your capital is at risk. You sign up, go to the Financial Thing website. You'll see a Kuflink banner, or you can go to the cashback page. If you're a new investor, get yourself some cash back investing through Kuflink. Let's see, anything else? Yeah, I hope you enjoy. I see a comment here about MicroStrategy. Yeah, I was actually thinking about MicroStrategy and whether that might be a good company to buy stock in, but it kind of feels a little bit too pricey at the moment. But very much based on Bitcoin. And you're right, if Bitcoin does shoot up, MicroStrategy stock will, but it's expensive, so way over $600 a share. We'll see what happens. Anyway, back next week. Thursday, same time, 7:30 p.m. We'll see you then. Thanks for joining. Hope everybody has a great weekend. Love you all. Be safe and be healthy.